Welcome back to the deep dive. Today, we're really zeroing in on a big name in digital security, CrowdStrike Holdings. CRWD is the ticker. And our mission today, it's pretty specific. We've dug through the material trying to figure out if this company meets that high bar of being a truly wonderful business. The kind you could potentially hold for, say, 10, maybe even 20 years. We're trying to look past just the quarterly numbers here.
Right, and that durability, that's really the core tension, isn't it? Because on one side, you've got this technology that feels, absolutely essential. It's driven by these huge accelerating trends that aren't going away. But then the materials really force you to grapple with the valuation, which is steep, and the way their financials work, it's a bit unique. Plus, there are these subtle kind of systemic risks people aren't really discussing much.
Okay, yeah, let's definitely unpack all of that. But maybe start with the basics. The business itself. How solid is it? The model looks pretty straightforward on the surface, almost simple.
It is, yeah. Remarkably elegant, actually. They're essentially selling. Think of it like a digital immune system for companies. It's called the Falcon platform. And it's a classic SaaS model. Software as a service, subscription-based. That's where almost all the money comes from, like 95% of their income. That predictability, that's huge for long-term thinking.
Okay, SaaS, predictable revenue. And the growth comes from that land and expand approach. How does that actually work for them?
Yeah, exactly. So they land first. Usually means they get in the door by replacing some older, maybe clunkier endpoint security system. That's the foot in the door. Then comes the expand. Once they're in, they start upselling, adding more modules, all cloud delivered onto that same platform. Things like identity protection or even their next-gen SIEM product.
Hold on, SIM. Can you just quickly break that down? And why next-gen?
Sure. SIEM stands for Security Information and Event Management. Basically, it's the system that pulls together all the security alerts from across a company, analyzes them, helps coordinate the response. Think of it like a central command center. And next-gen just means they've built it into their modern cloud platform. It's faster, easier to manage, less complex than the old legacy SIEMs that often needed, lots of physical hardware on site.
Got it. So why is this whole model so durable? Couldn't security just become, cheaper? A commodity feature that Microsoft just gives away?
Well, that's the thing. The demand is tied to trends that aren't just temporary. First, you've got the human element, right? Greed, crime, spying.
Yeah.
That's all just moving online. Cybersecurity is basically the cost of doing business in a connected world now. Yeah. And second, this whole digital transformation thing, it's not going backwards. Every new cloud server, every laptop, every phone, that's expanding the attack surface. So the need for sophisticated protection just keeps growing. It's structural.
Plus, you mentioned things like AI are actually making the threats worse.
Oh, absolutely. AI gives attackers new tools, makes it easier to overwhelm old defenses. And, geopolitics plays out online now, too. Cyber conflict is real.
Yeah.
So CrowdStrike, fundamentally, they're selling order. They're selling control in a world that feels increasingly chaotic online. And the forces creating that chaos, they're actually speeding up.
Okay, that makes sense. Now, the competitive fortress, the moat, this is where you said it gets really interesting, the threat graph network effect. How does that actually work? What's the mechanism?
Right, this is key. It's this incredibly powerful data flywheel. So picture millions of these tiny software agents like sensors sitting on all their customers' computers and cloud systems. These agents are constantly streaming security data, trillions of events every single day, back to a central AI brain in the cloud. This brain is always hunting for new threats, new patterns.
Not just known viruses, but new attack behaviors.
Exactly. That's the crucial difference. It's looking for malicious behavior, what they call an IOA, indicator of attack. When it spots something brand new, something it hasn't seen before, on even one customer's system, the entire threat graph learns it instantly.
Instantly. So every other customer around the world gets protected from that brand new threat almost immediately.
Instantly, globally. So more customers means more data. More data makes the AI smarter. Smarter AI means better protection. Better protection attracts more customers. It just compounds.
Wow. Okay, that's a powerful feedback loop.
It's a structural advantage. Really, really hard for anyone else to just build that overnight. You need the scale, the data flow.
So that's the network effect. But you also mentioned high switching costs. That seems critical for stickiness, too.
Yeah, that's the other pillar of the moat. It comes from the architecture, that single, lightweight agent's design. Often, when a company adopts CrowdStrike, they're not just replacing one old tool. They're consolidating maybe 10, 15, sometimes even 20 different security products from various vendors onto this one platform.
Okay, so it simplifies things for them.
Massively. And if they want a new capability, say identity protection, they don't install new software. They just click, activate that module within the Falcon platform. It's frictionless.
Which means if a CISO, the Chief Information Security Officer, decides they want to leave CrowdStrike,
Mm-hmm.
they're not just replacing one thing, they're potentially ripping out a dozen integrated tools, finding replacements, retraining their entire team, dealing with massive disruption and, frankly, huge security risks during the transition.
It's a monster project. It's the kind of decision that gets people fired if it goes wrong. It's a huge multi-year career risk.
And we saw this play out, didn't we? That massive IT outage in July 2024, that had to be the ultimate stress test.
Oh, absolutely. I mean, planes grounded, hospitals impacted. It was a global crisis, and it originated from a faulty CrowdStrike update. If the switching costs weren't real, if the moat was weak, you'd expect customers to run for the exits, right?
Definitely. You'd expect mass defections after something like that.
And yet, the exact opposite happened. Management reported, they avoided significant customer losses. Their gross retention rate stayed up there at an elite level, around 97%.
97%. After that.
Think about that. They caused immense global pain, real disruption, and almost everyone stayed. That, to me, validates the switching cost argument more powerfully than any theoretical analysis ever could. It proved the perceived pain and risk of switching, even after a real crisis, was seen as greater than the pain they just experienced. They are truly locked in.
That's incredible, actually. So it's not just one thing. It's the network effect, the high switching costs, plus they have a strong brand reputation as being best of breed.
And scale economies. Don't forget those 80% gross margins on subscriptions. That scale lets them reinvest heavily. It's like Munger's Lollapalooza effect. Multiple factors all working together, multiplying the advantage.
A four-factor fortress, essentially.
Precisely, and it reinforces itself.
Okay, let's shift gears. Let's talk about management, the jockey running this horse. George Kurtz, the CEO, he's a co-founder, still owns a huge amount of stock, right? Something like $2 billion worth.
Yeah, estimates vary, $1.9 billion, maybe up to $2.5 billion, whatever the exact number. It's massive. That's incredible alignment. His interests are directly aligned with long-term shareholders like you, the listener.
And beyond just the ownership, what about his approach, his capital allocation?
Well, he has this philosophy, they call it no digital taxidermy, which is basically a rejection of those big, splashy, often value-destroying acquisitions that so many other tech companies do, buying something huge and then struggling to integrate it. Instead, he focuses on small, strategic, tuck-in deals, buying technology or talent that can be immediately plugged right into the existing Falcon platform. It protects the moat, keeps the platform unified and elegant. Very disciplined.
And speaking of discipline and character, the response to that July crisis, that seemed telling too.
Hugely telling. I mean, most CEOs would hide. They'd send out a press release written by lawyers. Kurtz, he was on national television within hours.
And he said, "We're deeply sorry for the impact." His CSO said, "We've failed you." That's rare.
It's incredibly rare. It's radical accountability. And when you're thinking about holding a company for a decade or two, that kind of management integrity, that ownership culture, it's an intangible asset, but it's invaluable. The crisis was terrible operationally, obviously, but it actually gave us incredibly positive information about the kind of culture Kurtz has built there. That matters.
Okay, so strong management, aligned interests, integrity. Let's look at the financial fortress itself. They're GAAP profitable now, which is good. But free cash flow, FCF, that's really the number to watch for a SaaS business like this, isn't it?
Absolutely. FCF is king here. It tells you how much actual cash the business is generating after funding its operations and investments. And CrowdStrike's FCF is, well, it's huge. Over $1 billion annually now.
With really strong margins, too, like 31% FCF margin. That's elite.
Definitely elite. It shows the power of the model.
Why?
But there's a big but.
Yeah.
You have to look at FCF compared to their net income, their JAT profit.
Right. The elephant in the room again. Stock-based compensation, SBC. That seems to explain the huge gap between FCF and net income.
It explains almost all of it. SBC has been enormous, like $2.25 billion over the last 12 months. That's a staggering number.
$2.25 billion in stock comp. Wow.
Yeah. So while the business is throwing off enormous amounts of cash, that non-cash SBC expense represents dilution for you, the shareholder. Every dollar of that fantastic free cash flow is being divided among more and more shares each year. It significantly eats into the per-share value growth, even as the overall business thrives.
So that's the tension. Amazing cash generation on one side, but massive dilution, constantly eroding the value of each individual share on the other.
Exactly. It's the core financial paradox of this company. Prince cash, prince shares. Which one matters more long-term? That's the debate.
Which brings us perfectly to the next section. We've got a wonderful business, great management, but this huge SBC issue. And then there's the price.
Yeah, the price. At the end of the day, that's probably the single biggest risk for an investor right now.
Yeah.
The valuation is, well, it's rich. Extremely rich. Trading around, 130 times price to free cash flow, something like that. That price implies not just continued growth, but decades of near-flawless execution. There's basically no room for error baked into that price. Zero margin of safety on valuation alone.
And they do have serious competition. Let's talk about Microsoft. They seem like the permanent competitor, right? Bundling Defender for Endpoint free with their big E5 licenses. Why wouldn't every CSO just take a free option?
It's the question everyone asks. And the answer seems to come down to total cost of ownership, or TCO. It's not just about the sticker price. We hear this consistently from CISOs, from people actually using the products. The feedback is often that Microsoft's solution, while capable, requires a lot more work to manage effectively. A heavy lift, they call it. I saw one comparison, seemed pretty detailed, that estimated managing Microsoft Defender needed something like 4 full-time employees across 9 different management consoles.
4 people just to manage the security tool.
Yeah, whereas the same analysis estimated CrowdStrike needed maybe half a person, half an FTE.
Okay, wait. 4 full-time people versus half a person. That's not just about security features. That's a massive difference in operational cost and complexity.
That's the core insight. CrowdStrike isn't just selling slightly better malware detection. They're selling simplicity. They're selling lower operational overhead. They're saving companies huge amounts on expensive IT security labor. So even though the CrowdStrike subscription looks more expensive upfront, the actual TCO, when you factor in the labor savings and reduced complexity, can be significantly low. That's why people pay the premium.
That makes a lot more sense. So the growth path forward is really about continuing that consolidation story, getting existing customers to add more modules, taking budget away from older, clunkier vendors.
That's the main engine, yes.
Right.
Expanding within the existing customer base. And those newer modules, they've launched things like SIEM, cloud security, identity protection. They're already doing really well. Over $1.3 billion in annual recurring revenue just from those emerging areas.
Yeah.
That's the path to growing earnings.
Okay, but let's invert again, thinking about risks. The July outage didn't just prove switching costs. It also highlighted a massive risk, didn't it? The single point of failure problem.
Absolutely. That's the flip side of the platform consolidation coin. And it leads to what I think is the true, potentially existential systemic risk here. The biggest long-term bear case might not be that a competitor like Microsoft suddenly builds a vastly superior product. It might be that regulators, or maybe even just corporate boards themselves, get really spooked by what happened in July. They saw how dependent global infrastructure became on this one vendor, and they might say, this is too risky, we need vendor diversification for critical systems. Think banks, hospitals, utilities, if regulators mandate diversity.
That directly undermines CrowdStrike's entire strategy of being the single consolidated platform. It shrinks their total addressable market, or at least slows that consolidation engine way down.
Precisely. It attacks the core thesis. That, to me, is a bigger potential threat than simple product competition. The risk of forced diversification due to systemic concerns.
That's a sobering thought. But on the positive side, they do have things potentially accelerating growth, too. You mentioned Falcon Flex and Charlotte AI.
Right, 2 potential catalysts. Falcon Flex is basically a new way for customers to buy. It's credit-based. Instead of long procurement cycles for each new module, a CSO can use pre-purchase credits to instantly turn on new features. It removes friction, speeds up that expand motion, and Charlotte AI, that's their generative AI assistant for security analysts, the idea there is huge. It could help solve the massive shortage of skilled security professionals. It potentially expands CrowdStrike's market from just selling software to capturing budget previously spent on expensive human analysts, from software budget to the much larger IT labor budget.
Interesting. Okay, so let's try and wrap this up. The core investment thesis, if you're bullish. It's a business fundamentally tied to ongoing conflict, digital conflict. It's protected by this powerful, self-improving data moat, the threat graph. And it's run by a founder CEO who showed remarkable accountability in a crisis.
That's the bull case in a nutshell. It's compelling. But then you have these 2 really strong counter-arguments, these contrarian points you have to wrestle with. Is the market significantly undervaluing the intangible asset of that management character and integrity shown during the crisis? Or Is the market willfully ignoring the very tangible, very real erosion of per-share value caused by that massive ongoing $2.25 billion in stock-based compensation?
Both seem possible. It's a real tension.
It is, and you have to decide which factor you think will matter more over the next 10, 20 years. Because the current price, as we said, it's demanding perfection.
And perfection doesn't account for black swan events or regulatory shifts. That systemic risk idea. If regulators force diversification, not because CrowdStrike is bad, but because relying on any single vendor is too risky for critical infrastructure, the whole story could change. So maybe the final question for you, the listener, to think about is this. Is the systemic risk of having a security monoculture, too much reliance on one provider, ultimately a greater long-term threat than the potential financial rewards of CrowdStrike successfully consolidating the market? Something to mull over. Well, thanks for diving deep with us today on CrowdStrike. Hopefully this gives you a solid framework, a shortcut really, to understanding the strengths, the risks, and the core debates around this fascinating cybersecurity company.